Rob, this has been a miserable first quarter, not the way that folks wanted to start the year, especially after a great year last year. Is now the time that people can feel a little bit better about things, or are people still worried that another leg down could happen?
Well, Dom, it may be a little early to say that we can feel better about things, but I do think we're starting to see the light at the end of the tunnel. You know, Goldman Sachs has said that we're in a recession, but if the task force projections are correct, that we get the virus under control by mid-year, it should just be a two-quarter recession with a strong rebound the second half of the year. Now, historically, equity markets, they go into a bear market before you even know you're in a recession, which happened here, but then they start to rally before the recession is over. So that tells me, if Goldman Sachs and the task force are correct, that we could be in the next bull market right now. However, we may need to test those lows on the S&P 500 before we know we're out of the woods for sure. Those lows are 2237. We're about 400 points above that. So it's a little too soon to say. But one thing I'd make as far as markets go, Dom, is that and I've been saying this to clients, they should not be underweight equities here. They don't want to be selling out of equities. Don't want to be. They want to be at least market weight here, and then perhaps we will eventually start to see some signs that we're getting the all clear sign.
So how exactly then do you get market weight those equities, right? Do you just take that money and put it all in right now because you're feeling good about things? Do you layer it in? Do you go every week or so? Do you programmatically just buy every so often? How exactly do you get to that market weight if you're not there right now?
Well, and most people probably aren't there right now, because if they were at a market weight prior to all this happening, then they're going to be underweight right now. And I certainly wouldn't suggest just dumping it all in right now. So certainly dollar cost averaging makes some sense. If they do have some cash, begin to nibble on some favorite sectors, and as you say, layering it in, dollar cost averaging in makes sense.
All right, so let's talk about the names that you do like then. As we talk about layering in, what types of stocks are you looking at in particular? We know that there are certain sectors, cyclicals, that you like, but what exactly are you looking for to add to portfolios right now?
Yeah, well, I think, starting from kind of the 30,000-foot view, even though the Fed can't do a lot more as far as rates go, there's a lot of stuff that they can do to provide liquidity, and that's probably going to perhaps bring the dollar down. So that implies to me large cap growth stocks should do better than small cap value stocks because a dollar that's nudging down does that. And then within the S&P 500, I would definitely stick to more defensive sectors here, utilities, telecom, healthcare, and at this point I would overweight those sectors, and I'd be underweighting more of the cyclical sectors out there as well.